money, happiness, and time.
And 17 come more. What the fund? More than 90 investors. I don't believe it. I don't believe it. And I'm going to sell my company for $100 million in 2 years or 3 years. Come on. Are you sure? Why do I invest?
Today, at the Pitch&Chips podcast, we have Gleb Davidyuk. He is the founder and managing partner at iTech Capital. He is currently a board member in 10 plus companies, and he is actively managing $300 million. The fund has achieved 6 big exits in the previous 5 years and has raised 2 unicorns, TradingView and BitFury. Prior to iTech, Gleb was a partner at Mint Capital, a mid-sized Scandinavian private equity fund. And before that, he was one of the co-founders and the partners at Alpha Capital Partners. I'm really excited for you to hear his invaluable experience. So please welcome and tune in to Pitch&Chips with Gleb Davidyuk. I'm sure that apart from the investments that you bring to the companies, you're also massively involved in the daily operations, the so-called value-added services.
Yeah.
So could you briefly touch on iTech's involvement in the daily operations of the startups, of the projects?
So this is the key. Basically, the most, if you take any books which are written about how to invest, what is the value added, all the startups looking for the partners and blah, blah, blah. So imagine yourself that you manage, let's say, the fund, which is $50 million. So, and you invest into the startups. So how much money would you invest per one startup normally? 500, 1 million, 100?
Depends.
Well, I'm asking.
Well, depends. Maybe 100K.
100K. So now you have 15 million. How many startups you will have in 5 years?
In 5 years.
Well, lots of them will.
Let's say, just count briefly.
150.
150. So now imagine yourself, you are a fund manager, looking nice, $15 million of the management, you invested into the 150 startups, right?
Yes.
So, and then this guy is a startupper. So he was actually watching the TikTok show, whatever it is. And then a guy in the yellow t-shirt told him that the value added is the key. So you have to look for the partner who brings you the value added. And then you invested into his startup. And then one day he actually calls you and said, what the fuck my value added, man?
Where's the help?
And then you hate him as well because, 150 of them calling you every fucking day and asking for the value added.
And I call you twice.
Yeah, sometimes call you twice. And they never call you when they have a nice, nice performance or nice results. They call you normally when they have a problem.
I will block founders.
Exactly. So that's what I do. And then the value added becomes a myth. So it's impossible because the only limitation in life we have is time. So money is not the limit. Time and health probably. So those are 2 things which basically limit it. But time is the primary one. Therefore, you have only 24 hours a day. You have probably 8-10 hours as a working hours.
Yeah.
So let's say 10, whatever, 12 probably as a startup, you can have 15, whatever, but still, let's say 10 hours a day you may work. And then you just split those 10 hours to 150 startups you have in your portfolio. And then you just kill yourself. So it's
I would just delegate.
Yeah, so
Have lots of analysts, have lots of...
Yes, exactly. But that's how you jump to the second problem. So you as a startup, I was expecting that you will get a value from him. And then he delegated to some bullshit guys who was actually boosting you instead of being valuable.
Don't call me.
And that's another myth that you know some you may be also lucky. So the some you may get some kind of an analyst who's better than him, but yeah, but not necessarily. So that's a casino at the end of the day. Therefore, I don't do the venture capital because I mean you're right. You would have 150, and then you basically will think that, okay, guys, I gave you money, forget about my phone number. So call me when you have cash. And this is my banking account, just bring it to me. That's it. And then probably out of 155 will cover you the future and the losses and then makes you happy and etc. But 145 will be dead in whatever, 5-10 years. And then for you, it's kind of a bit of a challenge. So first of all, you have to forget about the startuppers you have invested. You have to forgive them calling you twice a day with the problems. You have to be able to write them off one day, and that's psychologically quite a difficult decision to make. So many, stress. That's why I have so much respect to the VC guys who basically manage 150 portfolio, because at the end of the day, that's damn hard. That's why we do slightly different thing. And then, by the way, you have investors in your back, right? So they gave you money,
Yes.
and then they call you and say, okay, how's my money? They basically tell you just one simple question: where's my cash? And how is business?
In the company.
And how's the companies we have invested? And then imagine you have to explain them you have invested into the 150 companies and actually try to talk about those 150 companies and explain them how do they perform, what do they do, etc. Most probably you won't be able to do that. Now, simply because they don't have time, you don't have any information, and the only thing you can explain them is the problems they have called you like 2 days ago.
Yeah.
That's it. So, and this is not the answer your investors want to hear from you.
Then I would invest in the startup that would solve this problem. Creating a chart of all money.
It's a dream. So basically, the ideal solution here is to invest into is to invest your own money only. So when you invest your own money, you are the boss. So you can blame yourself on any losses. You can blame and you can congratulate yourself on any wins you have. Right?
Just like the angels.
Yeah, like the angel investing. So this is that's why angels, friends, and family. I mean, that's level of initial capital is the key for the startups, rather than institutional money from the VC funds. Because VC funds are kind of a difficult piece of difficult fruit to get from the tree, from the investment point of view. But once you got it, then try to use it. And then try to call him not 2 times, 4 times a day, so he would, remember who you are, etc. So, but also try to call him not only with the bad news, only with,
My business results will show him who am I.
yeah, but to call him to talk about the good news you have. That's sometimes even more important because
Imagine enjoying the calls.
yeah, exactly. Imagine the life he has. I mean, 10 calls a day with the bad news only, and you can kill yourself in the end of the day.
Yeah, exactly. Actually, there is a belief that you have to be both a businessman and a scientist to perform well in the startup space. Because most of the things we do are experiments. Like 150 investments, right? They lead to how many exits?
It's up to you. Because, quite often you have to work on exits yourself. That's why we basically don't do by the way 150, we have 15. So that's why I allocate some time to the companies we invest in. And then at some point of time you start thinking of the exits and etc. And that's a beauty moment when you get cash in the end. So good if this cash is actually bigger than you have invested. that's great. Quite often it's not, and this is, but it's also still cash. but I would answering your questions. How many exits out of 150 startups? I don't know if you do at least 20% of that would be good.
Yeah.
But again, I'm now theoretically talking about that.
Of course.
Because I'm not the one who is having 150 startups.
And I haven't invested in 150 startups.
Right? We're both dreaming.
Yeah.
We're both dreaming here. So I can surely tell you that about my business subjects, like when you have 10 portfolio companies, 15 portfolio companies, then you expect to have at least 90% of them exited, 95. If I talk about my portfolio, then we have only one write-off. So where we basically, well, actually, to be honest, 3. The first 2 was pure small deals which we shouldn't do. The first 2 deals we invested in one startup 50K, in another one 500K out of the fund, which is $100 million. And you should not do the deals 50,000 per startup from the fund of 100 million, because that's just simply not efficient. Even though if you invest 50K and in the end of the day you do 20x on that deal, it's still not enough. It's still very little in absolute terms. That's why one of my advices to you guys, to investors, is just to think on absolute numbers instead of relative numbers. Cash is a king, Basically, you invest $1 million, how much absolute cash you get in your pocket in the end of the day. And that's why when I read newspapers and people tell you that, okay, we made 20x on that deal. For me, it's just nothing. It's just a matter of X. What is X?
Yeah, it's like startups posting results. We've had 600% growth, and it's growth from like 10 to
From zero, from zero, yeah, like thousands. That's no problem. That's why, the absolute numbers, the absolute size matters. Because, the dollar or euro or pound is just a pound, right? It's not a relative pound, it's real pound. And you get real money, you invest real money, and you always have this price for alternatives. You could probably buy a house instead of investing into startup. And that's when you talk to your wife, okay, dear, we're going to invest into the startup. And then she tells you, really? I was thinking we were going to buy a house. Look, we live in this shitty house, and you promised me to buy a house next year, and now you told me that you invest into the startup. And then you have to explain to your first investment committee, which is a family, that you have to invest into the startup instead of a house, which is quite a challenge, to be honest.
I want to switch to the question. I want to start with the question that we usually end with. Mm-hmm. So, you as a portfolio manager, managing a fund and a portfolio of companies, have a reasoning, a motivation behind it. And we want to hear why. What is the goal? What is the main why behind this story? Tell us a story why you're doing this.
You ask me, why do I invest? Or why do I invest into the specific business?
So, for some funds,
yeah,
investment is just a vehicle to solve different problems in different industries.
Yeah, it's not me.
Okay.
I'm cynical, so I'm very straightforward. So I make money all day. We don't have any social agenda behind. We don't manage social money. We don't manage any governmental money. We only manage, entrepreneurial private money, private capital. Private capital is probably the most difficult capital to manage from one hand, but also it doesn't have any restrictions, right? So basically that means that I can invest whatever I want, probably except for, I don't know, some gambling, pornography, weapon, so some shadow
your
stuff.
startup.
Yeah, some shadow stuff we don't do. But we also don't do any social agenda. So we have to create so many working places. So we have to have so many different races in our boards. Whatever. We don't do this. So we have smart people on the board, no matter whether this is black or white, lady or guy. So that's about it.
But private money is still usually used across three dimensions of value proposition: money, happiness, and time. Would you agree?
Yeah. Of course, that's what I told you. You have only 24 hours a day, so you have to invest smart from your personal point of view. So basically, you would probably invest into something which brings you happiness at the end of the day, which is damn hard. Then you have to count on efficiency of your time spent, right? So basically, you invest either $100 or 1 million, but the amount of time you spend on those two projects are pretty much the same. Amount of trouble you get pretty much the same, but the outcome on absolute numbers is totally different. That's why basically I would go for the second instead of the first one.
What makes you happy, Gleb?
Smile, I guess. So when I get what I was thinking to get, that makes me happy. When we don't have any, I also happy when I can explain things. I'm unhappy when I cannot explain things. So sometimes there are situations I cannot explain, and that makes me happy because I start thinking, and then this cycle of things is not great. So that's what makes me happy. I'm not probably there when you're happy when the social agenda is fulfilled. So I'm not there that. So I mean, I'm not the one who basically
Copy.
happy when the African guys, get their get their food. I'm happy for that, but I'm not the one who basically, will
Save the planet.
yes, I'm not a Greta Thunberg. So
Okay, fair enough. So, investment
yeah,
in early stages. How early do you invest?
$1 million cash flow.
Series A, Series B?
Yes. I answer the question differently. I invest when you have something to lose.
But everyone has something to
Reputation?
Reputation, this is the key, yeah. But sometimes for the startups or youngsters, particularly for your 22 years old guys or girls, they don't care at that moment.
So basically, when they have skin in the game, when they're all
Yeah, skin in the game is the key, probably. And ideally, when the skin in the game is fundamentally, you can touch that fundamentally. So you have something to lose with basically material. And then that's the whole structuring thing. Basically, when you structure the deal, you structure it the way that okay, so you punish the other side if something goes wrong and you get something material. And that's how you structure the whole thing. And then you bring lawyers, tell them
Liquidating preferences.
whatever it is. There's so many, nice tricks to use when we basically do this structuring. And then, but the key thing is your experience. That basically part of the psychology in the business. Because when you have years of experience, you've got so many, bad situations when you was over pushing. Sometimes over pushing, using too many instruments in defending your position as an investor is not good as well.
I wanna ask a question about a practical case. Trading deal. You invested 3 million, if I'm correct,
Yes, something like that.
to Trading View, and you partially sold your stake when Trading View was valued at 3 billion.
Well, first we sold partially stake for the first time when the Trading View was valued at 150 million. That was the first sellout. The second sellout was at 3 billion valuation. Yes.
So the question is,
and we still keep pretty significant part of that.
so with trading being now, I think the most popular trading website platform, with about 50 million users. When a company is successful, when it's getting good traction, good financial results, how do you decide if you have to hold or sell out?
That's a very good question. So I don't know what to answer to you. Truth or just
Truth, bro. This is a
No, please follow TikTok.
TikTok. So
this is a podcast about honesty.
you have answering that question. Hold or sell. There are many triggers for that. Not only the profitability. So from the profitability point of view, well, when you got the offer and it's economically good, then it certainly makes sense to sell. But then you start thinking, okay, if I sell today, what do I do with the money? Will I find the good alternative? Because you're always thinking of the alternative source of capital, of investment. What do I get with the rest of the portfolio? Will this company grow in the future? And probably I can get more in the future, and probably makes sense to wait and not to sell. Every time there are 10 additional questions you have to answer to yourself. And TradingView example is a very good one because the company is growing every year, and the valuation normally grows like almost $1 billion every year.
And are you still invested?
We still keep almost 10% of the business. Yes.
Oh, wow.
And particularly this case, I set up iTech back in 2011 with $90 million capital call and invested. 1 billion, every billion which actually top up the valuation of TradingView brings me the whole fund.
It's a good business model.
Just wait another year and get 1x on your fund.
Yes, I guess that was the question. How do you know if you to believe in the project or to partially take?
There is so many underwater behind. So the bigger the company, the bigger stake, the more snakes around. So it's unfortunately it's one of the things when you basically jump into the larger, bigger league in terms of sizes, absolute numbers, then additional forces coming in, politics, psychology, so many shocks around, etc. And that's dangerous. So that's why the bigger funds they have more risk factors than the smaller funds. So when you are under the radar, so-called, then it's easier for you to fund manager. When you're just, yes, you're famous, everybody knows you, but in the same time, so many people want to take part of your success. That's why it's important to be under the radar. Money lost.
So you like to be behind. You like to be behind the curtains.
Yeah, so ideally.
Great argument.
Ideally, and not to talk to the audience. And give the podcasts and stuff like that. So, by the way, it's the first time I'm doing this over the past 5 years, I guess.
So
In English.
And in English as well, yeah.
Any key messages which you want to
Pass down.
pass on to the audience? Perhaps
TikTok
a question
generation.
which I haven't prepared, but something which you want to share.
Don't spend hours in TikTok. Spend them studying and making something.
Advice from a fund
real.
manager.
Yes.
Invest in TikTok.
No, invest into yourself. This is the key thing, guys. Spending 6 hours or 5 hours a day in TikTok is good, but it's nothing for you. It's just just kill you. Then you end up with the glasses like.
Unless it's our content and unless it's an extremely smart individual like you talking, then
Yeah, but I actually I'm happy for you guys that you have so many technology behind now. So you have so many things to do and so many paths to go. And that's great. I think and I'm happy that the audience is so open for any new ideas. And there's so many things which you still can improve in this life, even socially. Though I was a bit aggressive. I'm sorry about that. But there's so many things to do.
Thank you.
Welcome.
Okay, so there's a thing called ramen salary, which is a salary that a founder gets paid in a startup,
Yeah.
and usually it's enough at least to eat ramen.
Yes.
How do you normally negotiate if you do the founder's salary, and what do you think?
Yeah, that's one of the things I don't want to negotiate, right? So that's why I don't want to invest into the startups, because when you have $1 million cash flow, I assume
You eat more than a lobster.
yeah, you don't need losses, but I assume you negotiate your salary.
You eat these beautiful chips.
Yes, you negotiate your salary. So basically, there's so many risks, like a death valley for the business, which I don't want to take care. Because I mean, you may have great technology, you may have a great team, you may have everything is great, but you may have problems in your family, and then you just, which I cannot control, and then your business goes down.
What do you think about Y Combinator?
What do you expect me to answer?
There's a demo day, and companies participate with valuations with no product
Yeah.
reaching as far as
Yeah.
25, 30 million pre-money. And would you consider them to have a reputation to lose or anything to lose? Would you consider an investment into a YC company?
Well, first of all, I must say that if they have been chosen by Y Combinator to speak on the audience, for the audience on the stage, that means already something, right? So, because Y Combinator normally does really, good screen before you go to the stage. That's something already. Whether they have something to lose, I'm sure they have, because for them this is like their life, right? So a reputation as well. But would I invest into those businesses? It depends. It depends on the business. I need to check that first. The different kind of accelerators were quite a good source for investments, right? So for potential investors as a pipeline source for the funds. But I wouldn't say that if the guys are a part of the Y Combinator, that is a certainly yes for me. Certainly not. And it's also not certainly not no. I mean, it depends. So because I would consider a good thing that this company is a part of certain accelerator, but it doesn't create a significant value for me when I analyze whether this business is good or bad.
And how many businesses do you analyze per day, would you say?
Well, before COVID, or during the COVID, let's say before the war, we were getting 5-6 projects a day.
Okay.
Yeah, now we get less. We get probably 2-3 a day. Normally we analyze a few thousands a year,
Wow.
like 3,000 something. But that's why this is not because we are so productive. That's because people do a lot of cold anything, and LinkedIn normally send me 3-4 opportunities. Out of that, 1-2 I'm sending to my analysts. 99.9 is shit. So basically, we see 2,000 or 3,000 projects a year. We invest 1-2.
So with so many shit projects, or
No, it's not means shit. It means that they're just not
Not to the level that-
not
Yeah.
fit my investment strategy. So I'm sure there are others who are happy to invest.
yeah.
I'm sure the projects themselves are great, but they just not fit my investment strategy, and that's key because I value my hours, my working hours. That's a key for me.
But you've analyzed probably 10,000 tens of thousands of startups in your lifetime. And have you noticed any correlations between a successful project and the project which fails? Perhaps a good.
It's a good question. All the correlations now in the textbooks. Let's get it into the business schools and the universities. I am happy in doing what I'm doing because every time there is something new. Every time when it's a great business, I mean the investments in general. So you basically analyze different projects. You talk to the people. You see lots of people. You see technologies behind it, technological stacks behind it. You see the trends. So where this trend is going, or that trend is going. You can basically see what will happen in the next 3 to 5 years from now, based on your day-to-day experience. Basically, you have this opportunity to, because people come to your office, and you're on the buy side. When you're on the buy side, you are the king.
Yeah.
When you're on the sell side, you're not.
Yeah.
So, and then as a seller, you basically need to open as much as you can. And then as a buyer, you just, sitting and choosing, okay, this is good, this is bad, this is good, this is bad. And then at the end of the day, you accumulate a lot of information. And then subject to the fact that you basically can use this information in order to do the right investment decisions. This is the key. But the experience is also the key. So basically, I'm in the business since 1995, almost 30 years. I've seen so many things. But when you're in the same business like for 5 years, you may be street smart, you may be, you read a lot of books, but just life experience, you need to have that as well.
So what's more important fundamentally? A good business model, a good idea, or the founding team?
Both.
Of course, it's a combination. It's always a combination, but
Both.
with the business model, you can iterate. You can.
No, the founding team probably the best. I mean, the keys. I mean, you may have good ideas made by not smart guys, and vice versa. So, but the smartest guys, even if it is bad, they can make a beauty out. They can make money out of anything if the guys are behind the great team. I think teams is key, people.
Do you have a favorite business model?
No.
Okay.
I mean, again, let's go back to the basics. Cash is a king. If your model makes $1 million cash for a month.
Dividend model.
Dividend model, I love it. Yeah, love it. So we've been doing that since the day one, since 2011, right? So, and that helps a lot for many reasons. Well, first of all, I manage primarily private money, as I told you, right? So we have more than 90 investors.
90 LPs.
Yeah. So imagine, right? 90 phone calls. Like you would get 150 phone calls from your startuppers. I'm getting 10 from the startuppers and 90 from investors. So also not fun. But
And you know them all personally.
yeah, of course, because they give you. I mean, that's the key for the private capital. So private money, they watch your eyes, so they don't do all this Excel spreadsheets to analyze your performance. So they want you to be behind the scene. They want you to be responsible for the money they trusted to, and that's part of my job as well. And that is the difference between the institutional money and private money. So private money are more, well, to me, they're more, difficult to get from one hand, difficult to manage. But once it comes to an entrepreneurial approach, they're more easy to go because there's less bureaucracy behind, which is good.
And would you say it's the same model as the United Nations Security Council, where every member has a veto and could block out the deal? Say,
That's one of the structures in the funds. having a veto legal-wise is not good. It's bad because again, many of your investors has different agendas behind. Then give them an informal veto. You may, of course, you call them and look, we're going to do this. What do you think? And then if your investor tells you, I have had this experience before, it's not a great idea, etc. Then you, as a manager, you think twice. And then you have basically two options: either to make this opponent happy, but they will never accept the fact that they were not right when they told you that this is a bad deal. So ideal scenario you can get is that they make a kind of neutral decision. Say, okay, I'm neutral, so this is your responsibility. That's the best you can get.
Make a decision and then make it right.
Yeah, yeah. But I told you that this may be better. And then, or you don't do a deal. Sometimes you pass that, and then when this deal fly away or skyrocket, you meet this guy and tell me, remember, I told you that would be a good deal, and you told me no. And we had these situations before, and then you use this as leverage all the time. Next time when they tell you, well, first of all, they will never tell you again that this is a bad deal because they've been wrong already, and you have a very good leverage against them.
Coming back to the dividend model,
Yeah.
could you kindly explain to our audience what that concept is?
Well, we basically invest into the companies which has an excess cash. And ideally, if this cash being distributed as dividends, part of the cash is basically invested, part of the reinvested, part of the cash is distributed to you as a dividend. That's good because as a fund manager, you make your IRR better. IRR means investment returns. And that's one. Number two, the dividend may cover the cost for your LPs. Your LPs normally pay you management fee, right? So we have the average management fee in the industry is 2% a year. We were paying the dividends yield of 5-6% annually on average. So when everybody or one of my 90 LPs start complaining, I'm like, come on, you paid 2%, you got 6%.
You pay minus
Still,
you
still
pay
in the money. You're in the money. So that makes them, at least calm and quiet in respect to the fact that they pay for something which they probably would think should not be paid.
They pay minus 4% for management fee.
And that's another reason. And another reason is that economic cycles are cycles at the end of the day, and you may go up, you may also go down. And probably one of the things we don't do or don't want to do as a fund managers is to save the companies which are going down, because investing good money after the bad money is not a good idea. And the companies which normally has an excess cash, they are more safer than the companies which doesn't have cash in the bad times. Right?
But why would you take the cash out of a growing company? Wouldn't it increase the gravity force?
Yeah, that's a good question. That's everybody asks me. But in the end of the day, everybody are happy that they have had that cash in the bad time. Because, first of all, it's not my decision to take out the cash, right? So this is their decision.
The company.
Company's decision, of course. So they basically see that they don't need the cash for reinvestment. And that's why they distribute it. Second, when the founders start thinking as a shareholders, right? And they understand that their wealth is created out of the dividends and not out of the salary. That's basically makes me happy because we're on the same page with that.
But you pay the taxes earlier than you would.
What do you mean?
When you withdraw the money, you have to pay the tax, right?
When I withdraw the money as dividends,
Of course.
You mean dividend tax?
Dividend tax, yes.
Yeah, the company pays the dividend. That's fine.
Yes.
As a fund manager, not, because we are not structured through the jurisdictions which require you to pay the dividend tax or capital gain tax.
Good.
Well done.
It's not easy. That's why I'm doing the compliance now more than I should.
Be smart about taxes.
Yeah, pay taxes.
Pay taxes, but be smart about them. Mistakes. Mistakes are portals to discovery. But it's better to enter the portals through other people's mistakes. Gleb, your worst deals, biggest
exactly.
regrets.
Exactly. So the biggest regrets.
Yeah.
Well, I don't know. Of course, there are companies which we could have invested and we didn't invest it for some reasons because we were too aggressive or we were too conservative, whatever. So,
Could you give examples, please, and why you didn't invest?
I don't know. No, I cannot give you examples because I don't remember. I tend to forget the bad things you did. Because otherwise, if you keep those things, then you're dead pretty much soon. So that's why I cannot give you an examples of that. Another regrets is they are related to the geopolitical situation. So I'm really unhappy that we are part of the turmoil which is going on in the world, and we have to adopt the business model now compared to what we had a few years ago. So the few years ago, life was so good. Now the life is quite difficult, and then the future is not that bright as it was as we were thinking like a few years ago. And the regret is that I cannot do anything about it. I just follow. That's a little regret. So I have to follow.
Follow and adapt.
Yeah, and adopt. So adoption is probably one of the skill instead of changing anything or creating anything. So I love to create instead of adopt. And here I have to adopt. That basically against me. That's another regret. In my past, I did the wrong decisions, in creating the teams, and that's another regret as well. So I was actually pretty naive when I was younger, and investing into the team spirit stuff and blah blah blah. So I'm now less naive because I've been hurt, and that's another regret.
So is it when you mixed friendship and work partnerships, or?
This is when you make too many expectations from the team, right? So again, all the textbook tell you that you have to invest into the team building stuff and blah blah blah. I don't believe it. I don't believe it. It doesn't work, particularly with the younger generation. So welcome, guys. So because you're all personalities, you are not team players, unfortunately, and that's why I probably don't think that investing into the team building stuff is something you have to divorce yourself or you have to devote yourself.
Lots of time and resources.
Exactly. So basically, you have to have it. That's part of your job, certainly, but it's not the key thing.
But the key thing is just hiring the smartest people.
Get the smartest people. Try to identify what makes them happy, and that's it. Not necessarily. Probably instead of couple team spirit event, another couple grams on their salaries makes them more happy than drinking together in a pub. That's why it's all about personalities. Certainly, there should be something like you have to know the team. So you should be together in the office. You have to be able to share the opinions and look to the eyes each other. But it's not that important as I was thinking 10 years ago.
Talking about hiring people and building teams, somebody would say access point to that, the secret sauce is actually recession because the cheap resources are here to take. Would you agree that economic cycles basically lead to us startups hiring best teams during the session?
Theoretically, yes. Practically, I don't think it's here yet. So I mean, good guys or girls have a good price always, and no matter whether this is up or down in the economic cycle.
But sometimes people don't understand their own value just because
And that's the key. So you have to find out the one who doesn't understand his own value yet. So basically, I prefer to grow up the teams from the inside rather than to take out an expensive manager from the street. So I prefer to grow up my own team instead of bringing expensive stuff out from the outside. But that's not necessarily a right approach.
Let's talk about hiring.
Yeah.
So Uber,
Yeah.
when they were hiring people, they had a strategy. They would ask their best engineers to give recommendations, just if you know someone.
Yeah.
And they would literally hire them without even interviewing people.
Yeah.
So, and then there's a saying that there's fishing and hunting, two known strategies.
Yeah.
Whether we put a net and we then wait for the fish to come, to the best people to come, and we go through the interviewing processes and stuff.
Yeah.
And then there's hunting when we know who is the person, where he's working.
Yeah. It's relevant to the corporations, right? So in the fund management team, normally the fund management teams are very small and narrow. So we have 10 people, really. And I think the maximum we have had probably 13 or 15. So, and you're basically balancing between that amount for the fund, which is $100 million size. If you actually get to the point where you have 100 people on board, then the rules can be changed, right? Then you start hunting or fishing, whatever it is. But
Motorcycling.
yeah, you can do whatever. But when you have a 10, it's so small, right? So basically, you easily manage. It's not HR is not that big of a problem.
Do you believe in vertical growth, horizontal?
Yeah, that's what I told you. Yeah, I'm growing guys vertically from down to the top. The problem with this is to motivate them on this long run. The investment business, particularly venture capital, private equity, whatever it is, it's a marathon. You have to understand that, right? When you come stepping into this industry, it's a marathon because you may be a pretty good investment banker, and that's a short run. So you do one deal, you get your fees, you're done. You do another deal, you get the fees, you're done. And the more deals you do, the more fees you get, the more bonus you paid, the more money you make. In the portfolio management business, private equity, venture capital, the cycle may be 5-10 years. On average, 10 years. So do you think 10 years in advance?
Yes.
You think 10 years in advance?
No,
You should.
Think 10 years in advance.
You think 10 minutes in advance, but not 10 years. And you never know whom you're going to be in 10 years' time, right? And that's why when you're growing your team, right? So you basically need to understand that at some point of time, they either run away because they become bored or whatever it is, or they may stay longer than 10 years. And that means they become partners. So they're basically growing up from analyst, whatever it is, a junior position to the partnership position. Then if you're able to motivate them through the partnerships, then it's great.
Would Mr. Chips?
Thank you, Mr. Pitch. There are students in our audience, they're young individuals, and I wanted to briefly ask about your education. So you completed an MBA in Chicago Booth.
Yeah, I did.
You have a PhD in finance. Was that helpful? Would you recommend, for example, doing an MBA? Was that helpful towards the venture world,
Private equity world,
private equity world, startup
portfolio
world,
management world,
finance world.
generally.
Is that helpful for the world?
Yeah, I'm not the good guy to ask that question.
Cut. Okay, let's go back to
You would probably expect me, to start. Oh yes, it's great. And blah, blah, blah. Go ahead, spend.
MBA is shit.
Yeah,
Spend.
it's good. It's good for network.
Cut.
No, but okay. Let's
Uncut.
uncut a little bit. First of all, what is totally useful is that the business school gives you the opportunity to systemize your knowledge, right? So basically, you may be great knowledgeable guy, but they tell you, okay, so statistics is here, maths is here, economics is here, psychology is here, and so on. And then you basically understand which shelves is
You organize.
you organize your knowledge a bit, you structure it a bit, and that's probably the best value you can get. Other than the networking and blah blah blah, so, line in your CV. MBAs, business schools, are great for the mid managers dreaming to become top managers. That's perfect. For the entrepreneurs, that's a bit of a frustration. So basically, you think you know everyone and everything, and then they tell you, okay, wait a minute, forget everything you know. Now let's start structuring, and then you start structuring. Sometimes you get a benefit of the fact that the networking effect becomes valuable for you, but. Most of the value is for those who are in the mid-level, corporate level, wants to jump up.
So would you say it's beneficial towards managers to have a structured, for their knowledge to be structured, but for entrepreneurs, it's more of a...
For entrepreneurs, it's more of a knowledge and networking. For managers, it's more of a trampoline to jump because they have a line in the resume.
So it's more of a status thing,
More of a
reputation.
status, including networking as well, because they basically do a lot of the networking events as well, and they have an opportunity to actually utilize those relations in the future. For example, I did in Chicago move 10 years ago, right? So in 10 years, many of my classmates made a significant move in their careers. And then 10 years ago, they were like one level down. Now they're just in the skies. And 10 years later, you start enjoying. This guy is now there. I have his phone number. I'll call him, and etc. But again, it takes time.
I've noticed you have a small startup inside the fund called Air.
Yes.
You build a product. Can you tell us more about it?
This is
Tell the world more about it.
This is for legacy, guys. I mean, it's all about the. As I told you, this is marathon, right? So I'm running like 10 years, 20 years, and then 10 years later, you realize you have so much on your back. You have to carry out of that. All the papers, all the relationships, all the portfolio management reports, all the compliance papers, and blah, 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 blah. So, as a fund manager, you just have a team of 10 guys behind you. And now imagine one of them just decided to leave because they actually become bored. You don't do any corporate events for them because you're cynical and don't believe into team building. And so, yeah, and then you're just, okay. What do I do? And that guy actually had the keys from the Google the Drive with all the papers and etc. And then, of course, you think, okay, so what do I do? Within the Air, you have everything there. So basically, you have a platform with the portfolio management, compliance relationship, reporting, and etc., etc. So, and that's from, as I told you, I have a few dozen SLPs. And that's for me perfect to communicate with them. Other than this is a marketplace as well and chatting platform and stuff. But the key thing is for me is is that, okay, you call me, you ask me how things are doing and going, and I tell you have your
Login and password.
everything is there. Why are you calling me? And then they have nothing to answer to it. Then they typically say, oh, I forgot it. Can you remind me? Yes, that's I can. No problem. So,
And can other funds leverage that? So
yes, we can do this. And some of the funds do. We're not actively selling, to be honest. Not because we don't want to sell, just because I don't have time to do that. And that's my problem as a startupper. But we use it ourselves. A few other funds are using that as well. If you guys decide to use it, welcome. And this is for those who wants to be happy that their back office operations are under control. By the way, we have also not the private equity part of the, but also public equity part. So this is a tool for your family office to understand where's the investments, how are they doing, what are the documents behind, and blah blah blah, all of this. And instead of having 10 people in accounting, 5 guys in investment management, etc., for you as a family office manager, you just have 1, 2 probably, and everything is there. And those 1, 2 can also be fired any day. Just replace, as long as you keep the passwords and login. But you can always have an opportunity to call Gleb and ask for the login as well.
okay. But is that is Air yours or is that the funds? So do the LPs have?
No, that's ours. Yeah, that's been created when I had a problem with my team, who actually decided to leave one day. So I wake up in the morning and then I realize that I have nothing. I have no financial keys, no Google Drive passwords, nothing. And then I actually got a partner, a CFO, Natasha, who is been smart, and she actually made the platform. And then we started to do coding, and then we realized, okay, there is a product, and a lot of investors came in and asked us, why don't you release it for the third parties as well? And I thought, okay, probably makes sense to release it. Then we release it. That's how it's today. But still, by the way, I'm looking for investors. If someone wants to invest,
Please join. Have you ever been to the casino?
yes, of course.
Do you know how to play roulette?
Yes, I know.
So I want to make a small test simulation to find out more about your risk preferences. So imagine you have $100 note. You're standing in the casino. You can do whatever you want. You can leave if you want.
For $100.
Yeah.
What would you do?
You could buy a cocktail and food.
Well, I would buy cocktail for 10. I would buy another cocktail for 15.
Which cocktail?
And leave.
Whiskey sour.
Whiskey sour.
No. Then I would put 25 on black.
On black, okay.
And then I would live. Either with 50 and 2 cocktails, or with 100
If you
and
win.
2 cocktails.
So if you won, you still leave.
Yes.
Okay.
So you would not risk
Going forward, no.
not place on like a lucky number.
Look, I can explain. I've got 2 cocktails. I had my endorphin investing into black.
Gleb is happy.
And I still have 50 on my pocket for another 2 cocktails at least, or 4 cocktails. So
You can invite friends.
I have, yeah. So basically, I've got everything I was expecting to get when you come into the casino. You want to get some fun, you want to get some drinks, and you want to get some endorphin. I got 3 of them, and I still get money. And have a chance to not even to lose, to double the money.
And you save time.
And sometimes, yeah. Well, that's the key. That's the key.
You save time.
That's the key.
So what's next for iTech?
It's another difficult question. So first, the next for iTech is to actually keep, well, first of all, return money what we have invested. So, but as of now, we have returned everything with the profit already. But now to return the capital gains. So that's number one, and it's significant money basically. Then Goal number 2 is to keep iTech going forward, but slightly in a different form, as a club deals primarily. So, and that's probably what iTech is going to be going forward.
As a club deals.
Instead of a fund management, yes.
Could you explain to the audience what club deals are?
We invest deal by deal instead of fund. So once we have a good deal, we get together, we invest in. And to become part of a iTech club, that's the key. So I'm not taking everyone. So I will choose who to invest with. And from the fundraising point of view, it's fundraising on the deal by deal basis instead of the fund wide.
So are you exiting from all your current positions?
No, we keep them. We keep some of them. We keep some of them. We exit. Then going forward, and we also invest in. We invest in that with the iTech Fund 2, which is by the way open. If someone wants to invest into Fund 2, welcome. But whether I want to have Fund 3, Fund 4, Fund 5, most probably no. I think iTech Club, as we call it, iTech Family, is a better solution rather than iTech Fund 3 LP.
iTech Fund Pro Plus.
It's the
Pro Max.
iTech Fund, iTech Family is just more, you spend time with the family.
It's for the family.
Buy a house for your wife.
No, well, she wouldn't probably reject, but no, it's about the relationship and fun. Because what I realized that over the past 15 years within the iTech, 14 years within the iTech as of now, then it's a more of a relationship business. So many individuals, so many stories behind, so many business stories behind. That's pretty valuable language, and I love it. So I managed to survive, with the 90 angry LPs over 13 years, and made some of them, if not all of them, happy. Then I think this is the key, and I would love to keep with this language going forward.
Imagine you're 18 now.
Yeah.
And your goal of life for the next 20 years is to actually create a fund. So macro level things, what would you do? You can choose to go to private equity and study that. You can basically do whatever you want. What would be your path?
Go to the bar, get 2 cocktails.
Shall we go to the bar?
I'm 18. Come on. What the fun?
What the fun? What the fun?
What the fund?
We're not talking about.
That's going to be our catchphrase now.
We're not
fun.
When you're 18, you're certainly not thinking of your next 20 years going forward. You are thinking of next 20 minutes, whether you have money for the cocktail or not, or whether you are allowed to have a cocktail in the bar or not. When you're 21, 23, you start thinking of your future, and that's slightly different. And then when you're 25, you basically start, okay, I'm 25, wow, I need to do something already. I'm not sure that 25 years old is able to make a fund. Simply, you basically don't have this life level experience, right? So you may have, again, street smart, you may ever have money, so family has money, whatever, but you don't have just professional experience.
So first get professional experience.
Get the professional experience in another fund, in an investment bank, in any big 4 or whatever, 5, 10 consultancy, or in the family office. Just get the smell of problems. Once you smell what the problem may be, not the nice part of the investment side, but get the troubles first, or at least touch the troubles, in order to understand, not to do them in your future career going forward. That's the key.
So imagine there's no life tomorrow. We all die.
Yeah.
How many cocktails?
Imagine there's no life tomorrow.
Yes.
And we all die.
Yes.
Where would you invest your last, I don't know, X sum?
Where would I invest?
You have
last summer.
you have to make a decision. Everyone dies tomorrow,
Yeah. Well,
but the world continues.
no, we're gonna spend some last summer, next summer with family, of course. Your friends and family. Invest into your friends and family. Well, if you're gonna die anyway,
Yeah.
get the 2 cocktails.
Yeah.
What the fun!
Well, it's but I don't think that's essential. If you ask me whether I want to make, a shelter to actually live the next 50 years in the shelter,
Yeah, for example. No.
no. Get the most of your life here.
And do you have a life now? Do you have a work-life balance?
Now I have.
What the fun! Thanks for chips.
Yeah, thanks for the COVID. I do. The COVID made me a bit quiet in terms of business life. So I was traveling like hell. I was, meeting people, spend a lot of time, etc., and less time with the family. Now with the COVID, I had to spend more time with lots. So and I'm slowly coming out of this back to the business track, but enjoying the time with my family and the kids. That's the beauty.
Last 2 questions from Mr. Chips and Mr. Peach. So, please start, Mr. Chips.
How about you start? I'll be a gentleman.
Okay. So, coming back to investing, sometimes funds, people generally invest in things they don't understand because they like the feeling of shaking the hand to the uncertainty.
No, I don't agree. The fund managers never invest into something they don't understand. Most probably, well, first of all, when they make the investment decisions, they're 100% sure they understand what they do. And because they have investment committees, they have analysts, they have reports, they have made due diligence, and blah, blah, blah.
Or just FOMO.
Well, yes, but the processes are structured the way that basically you prove yourself and your partners that you do the investment decision which has been clearly proved and the concept has been proved and you understand what you do. Otherwise, no one will let you know or will let you invest because this is third-party money. Unless you manage your own money. Once you manage your own money, you can do whatever you want. You may shake a hand and give the money, etc. But when you manage third people money, you may have to make sure that you understand what you do, and that's why I don't agree with you.
And
Thank you.
But then you understand it's like with the car, the car from the after saloon goes down in pricing immediately next minute.
Exactly.
Here is
I agree.
pretty much the same. So because once you have invested, you change your cap from the buy side to sell side. You start thinking of exit next minute, and that's basically a totally different story. And when and that's the key. When you have that's what I mean professional experience. When you have experience not only investing but also exiting. And when the startups come to my office and tell me, okay, we're gonna sell this company. Well, first of all, I'm valued 20 million, as you tell me, and I'm gonna sell my company for $100 million in 2 years or 3 years. Come on, are you sure? And I start challenging that, right? Because I have that experience selling the company. I know what it means to sell the company. I know how the pricing is done. And because we're trying to sell them every day, and it's damn hard. Sell side and buy side are totally different.
my final question is more of a personal one. Gleb, are you happy?
Yes.
Good. It's great.
Thank you.
Thank you so much for coming here.
Thank you, guys.
Thank you
Did you
for
like
coming
the
to
chips?
Yes.
Thank you.
Thank you for coming to the Pitch and Chips podcast. It's been a pleasure.
I'll bring a bin.
What the fun.